Hi, Dannie McKinnon from the Field Group Accounting. In today's video, we're going to talk about companies and what they're about and why you might choose one over some of the other structures that might be available to you. So a company is a separate legal entity, can incur its own debts, it can be sued, and it can sue others. Shareholders of a company are its owners, and generally those shareholders aren't responsible for any of the company debts. Each company must have one director, at least one director, and that director or the directors manage the company affairs, and they've got to act in accordance with the Corporations Act. When setting up a company, you incorporate it under the Corporations Act and you register it with ASIC. So the additional compliance and directors' obligations under the Corporations Act means that you need to have a pretty good reason to choose a company over a sole trader or a partnership, and that main reason is usually risk. So being a separate legal entity means that when the company is sued, only the company's assets are at risk. Now there's a little carve out there, so personal assets are safe unless the director's breached his duties or her duties under the Corporations Act. So quite often if we have a mum and dad come in to set up a business and they're going to go with a company, we might suggest that the family home be shifted into maybe the non-director's name, and that the director have no personal assets at all, to just give that added safety around their personal assets, especially the family home, which should be always the most protected asset. So the second reason you might choose a company is for tax reasons. So small business companies only pay tax on profits at 27.5 cents, where their turnover is under 25 million. So an individual who's earning 112,000 pays the same tax as what a company would earning 112,000. So that's sort of the tipping point, if you like. So once you're earning more than that, it can be beneficial to be a company and pay tax at 27.5 cents on that profit over and above that 112. But there's a bit of a catch in that really works well where the excess profits are being reinvested back into the company. So you might be buying additional plant and equipment, or your debtors are growing, so that the assets of the business are increasing, and you're only paying tax at 27.5 cents on that investment back into the company. Where it doesn't work is where you're not growing the company and you're ripping the excess profit out to buy personal assets, pay down personal loans, or our worst case scenario is where you're just spending it on personal expenses. Maybe just got a good lifestyle. But this leads to tax issues, so you've got to increase your wage or pay some dividends to shift that company profit back to yourself personally, because that's where the money's been spent. Third reason why you might set up as a company is for commercial reasons. So a company gives you a little bit more status and scale when dealing with other businesses or government departments. So quite often a contract that you might be going for, or a tender, it might be a requirement that you are incorporated as a company to be able to win that contract or tender. So quite often we'll set up or have a client required to be set up as a company to be able to deal in their business. A couple of other things to consider. Losses can be carried forward where shareholders are not changing, but those losses can't be shared with shareholders at the time they're made, so they can only be carried forward and used against future profits. Big negative is the significant setup costs and ongoing reporting requirements with ASIC. So that's why there's got to be that good reason to choose the company, because it is quite full on and it is a big responsibility being a director. If you do wish to sell your shares in the business or the company, or pass them on to other family members, it's quite easy to do so. So that's a positive. Another positive is that once the company has paid tax on its profits, the company can declare a dividend to the shareholders, and it's a good tax planning opportunity if the situation works out that it actually can result in a positive tax refund for shareholders if the company tax that has been paid is enough to cover any tax that the individual would have to pay on that dividend, and therefore you're able to get a tax refund. It was the big topic of the recent federal election in that one of the parties wanted to get rid of that franking refund and the other didn't. So, but we've got a result in that election that meant that we still can do that. So franking credit refunds still exist. And lastly, shareholders agreements. So we'd always recommend that anyone that sets up a company look to have a shareholder agreement put in place that sets out all the do's and don'ts for the shareholders and specifically deals with the valuation on exit. Hope that helps and explain a little bit about why you might choose a company for your business. Thanks.